Okay, good afternoon, everybody. Today's June 18th. It's your weekly take on the market. The market closed about an hour ago. I will be your host. My name is Scott St. Clair. I'm a senior product coach here at MarketSmith. Here's the disclaimer. Pause if you wish to read this. We will mention some stocks. Here are the gauges. Very strange market. I struggled with the gauges again. I mean, the market's in an uptrend. IBD has the market in uptrend. I'm a little torn. I'm not certain that if it's an uptrend, and it sure doesn't feel like an uptrend. There are some stocks that are setting up, some old leaders that maybe will just renew their leadership. Some really good companies. We'll talk about those. So I almost went green on the leaders. This would have been the strangest gauge ever. Yellow market, green leaders. And for me, my portfolio, I'm pretty certain I was down this week. The Fed day or the day after, anything resource inflation related didn't do well on Thursday, I believe. So those are your gauges. Let's go ahead and look at the markets. Then we'll jump to the industry groups. And then we'll go through, I think I'm going to do 4 stocks today because I couldn't decide on which one to remove. And then we'll go to the quote. So let's start with the markets. Let's pull up my MarketSmith. And here's a chart of the NASDAQ. See, the relative strength actually starting to turn up a little bit. If we take out this peak, I know I've talked about it, we better, at a bare minimum, take out that peak. Looks like we are, that we would be close enough. I think the S&P was down over 1% today, but the NASDAQ was down like a half or something, at least last I looked. But the relative strength is still lagging a little bit. So if we make another high and this doesn't participate, it's just strange market, but it's above the moving averages, it's above the 200-day. So, it's hard to argue with that. The S&P is starting to show some weakness. You can see a big volume day. I wonder if today was triple witching. This could have been options related, this really big volume. But this is the first close, although not decisive, but the first close below the 50-day since early this year. What's that? March 4th of this year is the last close below the 50-day. And in fact, we've only had in this year one close below the 50-day. This was, right on top of it, below it. So you see it's really respected that 50-day for a long time. So if it starts to live below that 50-day, it's going to be a real big warning sign for me. The S&P is not, it's the stocks that are in the S&P are kind of losing some luster. I guess I'm going to do 5 stocks because I can't help myself. But like Wells Fargo, not something that I would ever own, but it's going to drive the indexes, right? It's done really well, but now you're breaking below the 50-day. So finally showing some signs of weakness. Goldman Sachs breaking below the 50-day. So these are stocks that are interest rate sensitive, that are going to drive the indexes because of the weightings. And they look like they're, not broken per se, but the uptrend is spotty at best. Let's look at the bond market as represented by the TLT ETF. This is the 20-year Treasury. And this looks like a nice rounded bottom to me. And if the Fed is going to raise interest rates in, 20 years, like they say, or whatever it is, it seems so far away that they're thinking of raising interest rates. It's kind of weird to me that the market even cares about that. So the fact that they do bothers me a little bit. And this looks very rounded. It's been in a big bear market for a long time, and they had a couple of really strong days. And you're below the movie, finally above the 50-day, which is starting to turn up below the 200. But if this does really well, the money tends to, it's like a seesaw, right? The money it's got to go somewhere. It's got to go somewhere. So it's either in bonds, or it's in stocks, or it's in global stocks. It's probably more than one seat on that seesaw, but you get the idea. It's just a constant balancing of the money flowing everywhere. This strength in the bond market really interested me on Thursday. If the Fed is going to raise rates in the future, then why would you want to own bonds, right? Bonds should theoretically go down, but they're not. So that flight to safety or whatever it might be, I don't know. I just know that this is pretty strong price action. So if this is really strong, then it could be that maybe the money is flowing out of the indexes and stuff, and then you might look for the markets, the stock markets to tire. IWM, the Russell below the 50-day. So the jury is still out. I don't have any hard evidence on either side. A lot of time on IBD Live, they ask about the markets every morning. And honestly, it's like my least favorite question because I just don't know. I think the overall markets are really difficult. They send a lot of cross currents, a lot of false positives, a lot of false negatives. And so you don't want to read too much into it. That's why I put a lot of weighting on. Am I making progress? If my account is moving, it doesn't matter what the markets are doing. If my account is not moving, doesn't matter what the markets are doing. I'm either in sync or out. So I put a lot more weighting on, my account percentages and what am I doing? How was the week? Do I have anything working? What's not working? And then stocks that I wish I owned, the leaders, which I'll talk about in the next section. Let's jump to the industry groups. Let me go ahead and pull this up. And when I reviewed it before the video here, it looks the same. Nothing's really changed in the last few weeks. I just don't see anything really like, wow, look at the change in XYZ group. So, I go through this once a week or every other week thoroughly. For the video, I just do a cursory glance. I'm looking for something that jumps out at me. Like if I suddenly saw computer software security in the top 40, I'd be, wow, that's different. That hasn't been there before. But mostly this looks the same. Oil and gas, transportation, shipping is done pretty well. Finance, consumer loans, retail, etc. All right. Let's go to the stocks. I forgot my train of thought. I couldn't remember what was the next slide. Okay, so I have 4. Let's start with what was interesting to me. This one, OLO, O-L-O, is a newer name. Came out of this double bottom, first stage base. Really did really well, 35% at the peak, triggering that little power from pivot flag. I did not own this. I was literally going to buy it this day right there, because I felt like it had come in enough, but I wasn't having a good day in the market. I think that was that the Fed day or the day of the Fed announcement, and I was not a big fan of Fed announcement days. It's just so much volatility around that. So didn't do anything there. And then on Thursday, I thought about buying it, and I just didn't because I wasn't having a good day in the market. So I didn't want to put on any more exposure. But then today I was like, oh, I almost just top ticked it because I was tired of watching it go up. But it reversed really hard. And this is just kind of telling of what the market is doing. You can get ahead, think you have something good, and then it does this. Interesting newer company. It's on my radar. Let's go to the weekly. You're 4 weeks into this breakout, the very first space. So let's see what happens. If we open up the related information panel, I'm going to guess that all these guys got IPO stock priced at 25. They're 38. They're so far so good, but we'll see how it plays out. But that's pretty good institutional sponsorship for a really a much newer name. So this is something new that I think somebody on IBD Live mentioned it, and that's how I found out about it. I hadn't heard of it before. Let's go with CrowdStrike. So you're working on a third stage base. It's not a great base. Honestly, if I wanted to buy it, to me, this is the buy point. This is a cup with handle. If you were to, turn off pattern recognition and hand me this chart, 10, 15 years ago, I'd say cup with handle. There's the breakout. That's the buy point. I didn't buy it there because I owned a Zscaler in the same group. And so wasn't interested in putting on a bunch more exposure, but I do watch it, and it's a leader, and it's definitely a former leader, and it's I'm curious if it can hold these gains. It's kind of mid. I think a third stage base is to me is neutral. So first, second, or early, third, neutral, 4 and 5 and on are late. That's my 2 cents on the bases. Let's go to PayPal. Another great company. I really like to own PayPal when I think the market's going higher. It's one of my kind of go-to stocks for exposure, acting really well. Pattern Rec says this is a big consolidation. Again, I disagree with pattern recognition. I think this is a really large cup with handle, or actually a small cup with a large handle. But right or wrong, I think that would have been the buy point above 277.86. So that's how I would buy consolidations. I'd try to find some kind of pivot point inside. So acting much better. Maybe these types of stocks come back in favor. I know I've mentioned it before. Net, not a great base. Again, not a really good cup with handle, but this is how I would buy it. Coming out of that, kind of clearing, the resistance area that it kind of ran into. So these three are acting okay. They're not up a ton, but they're acting okay. So maybe the market's going to shift back to these names. I noticed today the market was down, but Tesla was up. And Tesla is a great barometer for the market. I don't think it was up much, maybe $5 or $6, but if the market's in trouble, I think Tesla is going to go down a lot if the market's in trouble. So I watch Tesla. I think it's a great barometer for the overall market. So there's a lot of cross currents. Then that's one of the advantages is we don't have to be, if you're not certain, you can be 30, you can be 40, you can be 60% invested. You don't have to be 100% like the institutions or specifically the mutual funds. I imagine most hedge funds don't have to be 100%, but the institutions, as far as mutual funds, pensions, they're pretty much always fully invested. Okay, so let's go to the quote. And Stevie Cohen, or Stephen Cohen, but I've always known him as Stevie Cohen. He ran SAC Capital forever. Now he just runs his own, family office, Point 72. And he talked about losers. You got to take risk. You're going to lose money. If you don't like to lose money, if you're afraid to lose money in the stock market, then you're better off in mutual funds or ETFs. There's just going to be some stocks that don't work. He said his hit rate at his firm was around 52 to 55%. That's their win rate. And these guys are the best in the world. So if you're not going to get it right 80% of the time, if you're looking to get it right 80% of the time, you're just going to be taking profits way too fast. You're never going to let anything really work. When he's looking at his sheet, when he's watching his portfolio, he says, I don't look at my winners, I look at my losers. I do that a lot during the day, but I think it's not the same reason he does it. I look at it because they're driving me crazy. But I don't know about you. If you have 10 stocks and 6 are up and 4 are down, I tend to watch the ones that are down, like almost trying to will them to come back. So, but he looks at them. He wants to see, why is it not working? Am I missing something? Has something changed? If I feel like something is changing and I don't know why, I will reduce. So I don't know if it was Market Wizards or it might have been. He was in, he might have been in New Market Wizards. But he talked about, I always tell my guys, if you have something that's not working, cut it in half. And if it's not working again, cut it in half again. And if you do that, I think that you're down to like a tenth of a position. So if you have 1,000 shares and you cut it in half, now you got 500. And then you don't like what's happening, you cut it in half again. Now you have 250. So you have 25% of the position you just had previously. You've reduced your exposure by 75% just with those two things. So that's a good strategy. If your stocks haven't hit your stop loss, but you don't like how they're acting, reduce. I reduce all the time, maybe probably too much. Probably, reduce the positions too much, but I would rather do it that way than not at all. I just don't like to sit on the railroad tracks with a big position and just where eventually the pressure of the price going down gets me that I do something, I overreact. So instead of reducing, I just take it all off. So it's better, if it's putting a little pressure on you, reduce. In this day and age, no commissions, liquidity is rampant, at least for if you're trading your own money. I'm not even going to go down the rabbit hole of taxes. I don't know if I've talked about that, but I've had some big tax bills in my life, and there's been years where I didn't pay any taxes. I'd rather have the big ones. Believe me, I'd love to write a big check to Uncle Sam every year. He's just a partner. And then, I have my tax-free accounts, which I think are golden. I love the Roth IRAs. I think it's a fantastic product. If you, my daughter just got a job, and I'm going to open a Roth IRA for her, and she's 16 years old. I'm going to get her started because that compounding tax-free is tremendous, can really put some points on the board if you have a runway in front of you. So if you have some kind of runway in front of you where you see yourself investing for 30 or 40 years, I'm not an advisor, of course. I've kind of gone off on a tangent, but I think the Roth IRA is really the coolest product that they've invented. All right, so let's leave it at that. Contact information, reach us at marcussmith.com, 800-831-2525. Thanks a lot. Have a great weekend, and we will see you next week. Bye-bye.